Hey folks, welcome to a product review at Finominal. Today we're going to look at the Main Sector Rotation ETF, which is the largest sector rotation ETF with almost $2 billion under management. Now, the ETF trades under the ticker SECT and aims to outperform its benchmark in rising markets and provide lower losses in declining markets. So let's find out if SECT has achieved that. Now, we're going to kick off with a benchmarking analysis and going to use our alpha analyzer tool for that. Now, we do see that the suggested benchmark is actually the Russell 3000, but if you look at the tracking error of SECT versus Russell 3000 or the S&P 500, they're both comparable, same thing with correlation. And the fund manager, i.e. Main Asset Management, does take the S&P 500 as a benchmark, so we'll stick with that. Now, what we can see that from basically its inception in 2017 to today, SECT has underperformed both indices, and we can see that even more clearly from an ex-return perspective. So that's not that great. Now, let's try to see in terms of what has been driving the risk and returns of this ETF. And we're going to do returns-based factor exposure analysis. Now, this is an equities product. Therefore, we see effectively that the beta to the S&P 500 is close to 1, simply because the ETF just rotates amongst sector ETFs like financials, energies, and so on. Now, the investment strategy is to identify undervalued sectors and allocate to them where a change might be expected. So theoretically, we might expect a bias towards the value factor because the aim is to find these undervalued sectors. Having said that, if we look at the factor exposure analysis, we do see that occasionally over the last, let's say 3 years, there was positive exposure to the value factor, but not in the period before that. There also doesn't seem to be any consistent exposure to the momentum factor or the quality factor. The only two exposures where we see consistent, consistent beta to that is the low volatility factor, which is almost consistently negative, and the size factor, which is consistently positive. So that simply means that the portfolio of underlying stocks tends to be more volatile and slightly smaller than the average stock in the S&P 500. Now, that's with regards to factor exposures. Let's move on to the alpha generation capabilities. Now, we already saw that there was very little outperformance compared to the S&P 500, and we can see that SECT only has achieved that in 3 out of 8 years. And from an alpha perspective, only in 2 out of 7 years. And it is worth mentioning that this product is quite expensive at 57 basis points. Now, if you look at the alpha generation over time, so we can look at the yellow bars, this, as mentioned, was almost consistently negative, except for, very little alpha in 2021 and some alpha in 2022. So effectively, if you kind of look at this from a cumulative perspective, most of the returns can be simply explained by the market. And the alpha generation on a cumulative basis has been negative. Now, that's with regards to SECT in terms of from a factor exposure perspective and also from an alpha perspective. Let's have a quick look what the sensitivity of this ETF is to kind of like macroeconomic variables. And we can use the risk monitor tool for that, where over here we see the sensitivity of SECT to a variety of macro variables like US GDP, inflation, bond yields, gold, oil price, VIX, and the US index. And SECT has a track record of close to 7 years, which is important because most of the macroeconomic data only has quarterly or monthly data points, so the longer the track record, the more meaningful. Having said that, if you look at the positioning of SECT, it's almost identical to the positioning of its benchmark, i.e. the S&P 500. And that's not unexpected, as we saw earlier, right? Primarily Main performs like the index, perhaps on an after fee basis, slightly worse. Now, that's with regards to SECT on a standalone basis. Let's move on to a peer analysis. And we selected 3 other sector rotation ETFs, as well as a S&P 500. And let's review the performance of SECT versus those peers. Now, since 2020, we effectively see that the performance was kind of in line with its peers, slightly outperformed in most the last 2 years, but then kind of like underperformed versus, well, the S&P 500 most recently. And so it's kind of comparable performance. But if we do recall that from an objective, the idea of SECT is that it provides a lower drawdown in declining markets. So let's have a look at that. We do see that the S&P 500 declined by 33% during its worst period of the last 4.5 years, versus we see SECT with negative 38%, so slightly worse. We can also look at that from a volatility perspective, in the sense that SECT wants to be less volatile, at least when markets are going down, but its volatility was 23% compared to 22% for the S&P 500. You can also visualize that on a simple risk versus return chart. So we do see that SECT was the most volatile product out of those 3 peers, and its return was not the highest, therefore offering a lower Sharpe ratio. In that case, there's a product from De Hagen at Davis Research called Smart Sector ETF that has generated the highest risk return ratio. And that kind of concludes our short product review of SECT. So we do see that it hasn't met its objective of outperforming the S&P 500, its benchmark, in kind of good times, and offering less volatility and lower max drawdowns in worse times. And that's kind of not surprising, simply because sector rotation is incredibly difficult. There are a few models how to do that, but the value angle that well, SECT is pursuing is a challenging one, because value tends to work over the long term, but there are easily periods of much longer than 4.5 years where it doesn't. And so in this case, if you consider this product for 57 basis points, just pure market exposure, i.e. the S&P 500, is probably the safer bet. That's it. Hope that helps. Have a nice day.